Most people think dividends are the ultimate passive income hack. Just collect your quarterly checks, sip your coffee, and let the money roll in. Sounds perfect, right? Here's the thing. Over the last 30 years, dividend investors who ignored index funds left an average of $200,000 to $400,000 on the table. Real money, gone, because of one simple misunderstanding about how wealth actually compounds. Now, I'm not here to trash dividend investing. I actually own dividend stocks. But there's a debate raging in every personal finance forum, every Reddit thread, every investing Facebook group, and most people are choosing sides based on feelings, not facts. Dividend investors say, I want cash flow now. I want to see real money hit my account. Index fund investors say, total returns beat everything. Dividends are just a gimmick. And both sides are kind of right and kind of wrong. But here's what nobody tells you. The real question isn't which one beats the other. The real question is which one is right for your specific situation at your specific stage of life. And the answer might completely change how you invest starting today. Imagine you're 32 years old. You're making $65,000 a year. You've managed to scrape together $15,000 to invest, which honestly is incredible because most Americans can't cover a $1,000 emergency. You open your brokerage account and you're staring at this fork in the road. Do you buy a dividend ETF like SCHD and start collecting real income every quarter? Or do you go all in on VOO, the S&P 500 index fund, and just let it grow silently in the background? This decision is not trivial. Over a 25-year timeline, choosing the wrong path for your situation could cost you tens of thousands of dollars, maybe hundreds of thousands. Here's what makes this so confusing. According to Morningstar, roughly 84% of actively managed dividend funds underperform the S&P 500 over a 15-year period. That sounds like a slam dunk for index funds. But then you hear that dividend-paying stocks have historically delivered about 40% of the total stock market's returns since 1930, according to Hartford Funds. So dividends do matter. They're just not the whole story. And here's the frustration that hits a lot of people. They go all in on dividend stocks chasing $500 a month in passive income, only to realize 5 years later their portfolio grew half as fast as their coworker who just quietly held a simple index fund. Or they go the index fund route, watch the market crash 30%, and suddenly wish they had some real cash flow coming in to stay calm and avoid panic selling. If any of this sounds familiar, you're not alone. This is one of the most genuinely confusing debates in personal finance. So let's break this down, for real this time. First, let's talk about what these two things actually are, because a lot of people think they understand, and they don't quite. When you buy a dividend stock or dividend ETF, you're buying ownership in companies that regularly share their profits with shareholders. Think companies like Johnson & Johnson, Coca-Cola, or Realty Income. Every quarter, sometimes every month, they drop cash directly into your brokerage account. No selling required. You just receive money. When you buy an index fund like VOO or VTI, you're buying a tiny slice of hundreds or thousands of companies at once, weighted by size. The S&P 500 contains Apple, Microsoft, Amazon, and Nvidia, the biggest growth engines in the world. These companies often don't pay big dividends. Instead, they reinvest every dollar back into growing the company. Think of it this way. A dividend stock is like owning a rental property. It throws off cash every month. An index fund is more like buying land in a growing city. It might not pay you rent today, but in 20 years, that land is worth multiples of what you paid. Both strategies build wealth. They just do it differently. Now, here's where it gets interesting. Let's talk about the number that makes dividend investors uncomfortable. Total return. Here's the thing most people don't realize. When a company pays you a $1 dividend, the stock price drops by $1 on the ex-dividend date. Automatically, it's called a dividend drag. You're not receiving extra money. You're receiving your own money back, just in a different form. So when someone says, I'm earning a 4% dividend yield on my portfolio, what they often don't realize is that their portfolio's price growth may be lagging because of it. A 2023 study by Vanguard found that over a 30-year period, a $10,000 investment in the S&P 500 would have grown to approximately $210,000. A dividend-focused portfolio with similar risk characteristics grew to roughly $145,000 over the same period. That's a $65,000 gap. That gap exists largely because the S&P 500 includes high-growth, low-dividend companies that crush the market over time. Dividend portfolios often exclude these companies, or heavily underweight them. But wait, there's more to this. Here's something the math nerds completely ignore. Human behavior destroys returns more than any investment choice. Vanguard's research shows that the average investor underperforms their own funds by about 1.5% per year because of emotional buying and selling. They panic when markets crash. They sell at the bottom. They buy back at the top. It's expensive and it's extremely common. And this is where dividend investing has a massive, underrated advantage. Imagine it's March 2020. COVID hits. The market drops 34% in 33 days. If you're holding a pure growth index fund, you're watching your portfolio bleed every single day. The temptation to sell is overwhelming. But if you're a dividend investor, your quarterly checks are still coming in. SCHD kept paying dividends through that entire crash. That cash flow, that psychological anchor, kept millions of investors from making the worst mistake of their lives. So yes, index funds may win on spreadsheets, but if dividends keep you invested when your index fund coworker panics and sells, dividends win every single time. This leads us to the next crucial point. Here's the insight that completely changes the conversation. Which strategy wins depends almost entirely on where you are in your investing journey. If you're in your 20s or early 30s, you're in the accumulation phase. You don't need cash flow right now. Every dollar of dividends that hits your account gets taxed, even if you immediately reinvest it. You're creating a taxable event for no real benefit. In this stage, index funds have a clear mathematical advantage. Let that snowball roll. But if you're in your 50s, approaching retirement, or already retired, the math flips completely. You need cash flow. You need income that doesn't require you to sell assets, because selling a down market is how retirees run out of money. It's called sequence of returns risk, and dividend income is one of the best natural hedges against it. According to Fidelity, a retiree who can generate 3 to 4% of their portfolio in dividends annually may never need to sell a single share to cover living expenses. That is powerful. That's true financial freedom. Income that keeps flowing regardless of what the market does. So the question isn't dividends or index funds. It's dividends and index funds at the right time. You might be wondering, okay, so what does a real portfolio actually look like? Let me show you what a genuinely smart, evidence-based strategy looks like in practice. Meet Alex. Alex is 29, earns $72,000 a year, and invests $1,000 per month. Here's how Alex thinks about it. 70% goes into VOO, the S&P 500 index fund. Maximum growth, maximum diversification, ultra-low fees at 0.03% expense ratio. This is the engine. 30% goes into SCHD, a high-quality dividend ETF with a 3.5% yield and a strong track record growing that dividend every year. This is a psychological anchor. What does this give Alex? It gives him exposure to the market's best growth companies, while also generating roughly $420 per month in dividends once the portfolio reaches $145,000. That cash flow gets reinvested automatically during working years, turbocharging the compounding. And when Alex hits 55, he can simply stop reinvesting and start living off that income. This isn't a radical idea. Warren Buffett will actually instruct the trustee managing his wife's inheritance to put 90% in an S&P 500 index fund and 10% in short-term bonds. Even Buffett, the most famous value investor in history, defaults to index funds for most people. The key insight is this: dividends are not a strategy for getting rich. They're a tool for staying rich. Use them at the right time. One more thing, and this one could save you thousands of dollars. Most people don't realize that dividends are taxable in the year you receive them, even if you reinvest every penny. If you're in the 22% federal tax bracket, every dividend dollar that hits your account costs you 22 cents to the IRS before it can compound. Over 30 years, that tax drag is significant. One analysis by PWL Capital estimated that tax drag from dividends can reduce a portfolio's final value by 10 to 15% in taxable accounts over a long time horizon. The solution? Use tax-advantaged accounts strategically. Put your dividend-heavy ETFs inside your Roth IRA or traditional IRA, where dividends compound tax-free or tax-deferred. Keep your pure index funds, which generate fewer taxable events, in your taxable brokerage account. This one account placement decision can add tens of thousands of dollars to your final portfolio value over a 25-year period. It costs you nothing. It just requires a bit of planning. So, what do you actually do with this information? Step 1. Clarify your phase. Do this today. Open a Notes app and answer this. Am I in accumulation mode, building wealth, or distribution mode? Living off wealth? If you're under 45 with no immediate income needs, you're almost certainly accumulating. This single answer should shape your entire allocation. Takes 5 minutes. Step 2. Start with a simple core. Do this week. If you're in accumulation mode, open a brokerage or Roth IRA and buy VOO or VTI. That's it. You need nothing else to start. Automate a monthly contribution. Even $100 is enough to begin. The habit is more important than the amount right now. Step 3. Add a dividend layer when you hit $25,000. Do this month or plan for it. Once your core index position is established, consider adding 10 to 30% in SCHD or VOOM. This is your psychological ballast. When the market drops 20%, those quarterly deposits keep you from making emotional decisions. Tools, Fidelity, Schwab, or Vanguard, all zero commission. Step 4. Place assets strategically for tax efficiency. Do this when setting up accounts. Dividend ETFs go into your Roth IRA or traditional IRA. Growth index funds go into your taxable brokerage. This placement optimizes your tax situation automatically every year without extra effort. Run your current allocation by a fee-only financial advisor once to verify. Step 5. Increase your dividend weight as you approach retirement, 5 to 10 years out. When you're about a decade from retirement, start gradually shifting your allocation. More SCHD, more VOOM, possibly some individual dividend aristocrats. Your goal: generate 3 to 4% of your portfolio in annual dividend income before you retire. That's your freedom number. Here's the bottom line. Dividends and index funds aren't enemies. They're teammates who perform best at different stages of your life. Index funds build the wealth. Dividends protect and sustain it. The investors who win long-term aren't the ones who pick the best strategy on a spreadsheet. They're the ones who build a system they can actually stick with through crashes, corrections, and all the uncertainty that comes with real life. You now know more about this debate than 95% of the people around you. Use it. If this video helped you think about your investments differently, do me a favor and subscribe. I put out videos like this every week to help you build real financial confidence, not just financial noise. Next week, I'm breaking down the exact 4-account system I use to automate my entire financial life. No spreadsheets, no constant monitoring, just money working on autopilot. You're not going to want to miss that one. Now, go open that brokerage account. Your future self is counting on you.